Hello, my fellow traders. My name is Michalis, and I'd like to welcome everybody to a new podcast. And today I have with me my fellow analyst, Andrea. Welcome, Andrea.
Thank you. Welcome. Thank you for having me. Actually, Mihalimu. Uh, it will be a very interesting topic, especially in regards to what happened so far this week, right? And we're gonna discuss about the Fed and what is
Yes.
expected.
So, definitely a trending topic. Today's podcast, we're going to speak about the Fed's decision and how the market, of course, has reacted to that decision. But more importantly, I think it's also related to not only what they've decided to do, but the indications we currently have on what they're going to do in the rest of 2025. So, Andrea, would you like to start off with confirming to everybody, of course, what the latest decision was?
Yes, of course. So let's brief you up a bit, guys. I'm sure, however, the majority of you already seen in the news or actually felt it in your in your platforms, in your trading platforms. Because we had actually we have seen some massive moves, some really sharp moves, especially on dollar pairs and gold. So basically what we have seen on Wednesday, it was as it was widely expected, because it was widely expected, right, Mihalim, regarding
For
the,
sure.
the cut, at least.
Mhm.
Yeah, so we have seen finally the FOMC cutting interest rates by 25 points. However, as usual, I mean, the focus is on the press conference, especially the last 2 years, especially actually since Mr. Trump is on the presidency. So we have seen Mr. Powell being a bit. I'm not going to say that it sounded a bit desperate, but definitely his press conference is what he has actually impacted the most the markets, and what has been how what has been it has been, sorry, the one that influenced also the increase of odds for December's rate cuts and for the 2026 predictions as well. So we have seen um, him saying that uh, there is risk basically in the upcoming months. He mentioned that there is no risk-free path from now onwards. So this was a bit a surprise. It was definitely a surprise after we have seen the slowdown in the jobs growth. Um, but still the concerns, as he stressed, they are on the tariffs, on how the tariffs have impacted so far inflation, and how much is expected to affect the inflation as well. So we have shifted, it seems, from the uncertainty and the uncertainty of labor market, of a really solid labor market so far, into the uncertainty of tariffs and how much they could affect inflation. So this is pretty much how the latest press conference has shaped the policy of the policy from now onwards, actually for the remaining of 2026. It was a pretty dovish tone that stressed that there is a lot of uncertainty, a lot of risk still in the markets. The Fed members have a lot of challenges, so a lot of risk management needs to be implemented. And it seems that every month they need to evaluate what they're gonna do, even though we have seen the markets already forecasting further rate cuts. So yeah, this is very briefly what we have seen so far in the Fed meeting.
He made it quite clear, I think, that they're in a very difficult position at the moment where they've seen growth, especially economic growth as well. It's much weaker than it was in the previous year. The employment sector definitely is starting to see cracks.
Mm-hmm.
But at the same time, yes, inflation hasn't increased as much as previously expected when tariffs started, but nonetheless, it remains elevated. So, of course, they're in a very difficult position at the moment where they have, of course, have two mandates. They've got the mandate, of course, to keep inflation at an appropriate level, but at the same time, support the employment sector and, of course, the economy. So it made it very clear, I think, that there's a lot of risks going forward. There's no easy decision, which was actually a quote which he specifically said in the press conference, that they're in a situation that they have to now start to support the employment sector because there is risks there, but at the same time they cannot make rash decisions and make unwarranted large cuts uh, because of the elevated inflation. So that's also one of the reasons I think why, like Andrea said, the market is pricing in further interest rate cuts, but most likely we're not going to see uh, significantly high or uncharacteristically high levels of cuts in a single decision. For example, if we look at what's currently expected within the market for 2025. Now, of course, in 2026, it's very difficult to provide projections because for half of that year, we will have a different chairman at the Federal Reserve. But for 2025, at the moment, the market is pricing in 25 basis point rate cuts for October and then the same again for December. If we're looking at possibilities in terms of percentages, there is a 92% possibility that we're going to get two further rate cuts this year. That itself is significantly higher than what we previously were seeing. Previously, about a month ago, if we're looking at the possibilities in August, we were looking at 46. So to rise from 46% possibility of two rate cuts to now 92 is a massive increase. And like this is the reason for that increase, because like Andrea said, the press conference, generally speaking, was quite dovish. But how has the market reacted so far, Andrea? If we're looking at, for example, like you said, gold, the US dollar
Let's
pairs, even the stock market has had quite interesting new highs and volatility.
let's actually let's start with gold. Okay, let me zoom in a bit. Perfect. Okay, so yeah, as we have seen actually a lot of pressure since the press conference on gold. But to be precise, this looked to be. Let me put the daily chart just to see the overall. Conditions and like start analyzing gold. We have seen a bit of a slight correction, I'm gonna call it, for gold since the press conference, since the meeting. I mean, you can see the daily chart over here. The doji candle in the mid is basically it was during the it was on Wednesday when the Fed took place. So we have a kind of a bit of a correction since then, with the gold retracing from 3700s down to 3650 territory, 3630. So we had seen indeed the precious metals reversing some gains. The same stands for silver as well after the Fed. But it looks for me at least, Michalis, I don't know whether you agree or not, it looks more of a profit-taking conditions, a bit of a the technicals took place rather than what Mr. Powell announced and how much he stressed the market. So with a dovish tone and he mentioned that they need to place more adequate risk management. They will remain data dependent. But he sounded a bit pessimistic as well. He said that we have only one tool. Our tool is basically the interest rate cuts. So from the one side, we need to control inflation. From the other side, we need to support the labor market. So with this kind of a cautious tone, dovish tone, I was expecting the goal to find more safe haven demand, but instead we have seen a correction, which to me at least, it looks like the technicals were driving the gold since then, some take profit conditions rather than fundamentals.
Yes, I mean,
How you see it?
in terms of fundamentals, of course, because we're looking at further interest rate cuts, most likely in 2026, a very dovish new chairman as well. In terms of fundamentals, yes, it can really support the price of gold. And if we're looking at the larger price movement,
Let me put
it's
the date.
forming rather a retracement. It's not showing so much momentum on the bearish side, which is actually giving us an indication that uh, institutions and investors have priced in interest rate cuts. And now, because of the press conference, they're in a situation where they've said that we've overexposed. We're not going to see as many cuts as previously thought. So we need to change the way we view gold. We're not seeing so much momentum that we're getting that indication. Like Andrea said, it looks more at the moment, and especially if we look at where the volatility was after the Fed's decision.
Let
The
me
Fed's decision and the press conference actually triggered a new all-time high, but
yeah.
it's like it has triggered at a new all-time high. A lot of pending orders, a lot of sell orders, and definitely, of course, profit taking. So
Mm-hmm.
at the moment, we don't necessarily have an indication that there's so much downward momentum uh, that we're getting an indication that there's going to be a prolonged downward trend at the moment. And also in terms of fundamentals, we haven't got something there quite to support it. So based on that, ladies and gentlemen, at the moment, we're simply getting an indication of a retracement. Um, but of course, it is something that we definitely have to keep on monitoring. Would you say, Andrea, that because we've seen such a strong trend in the price of gold, especially after we got two consecutive, very negative non-farm payroll figures, that really triggered the start of this upward trend? Because previously, gold was seen sideways price movement. There were in a consecutive high and low, definitely range bound trading conditions. We very easily broke out of that. I mean, if we look at that, we're looking at something like 15 consecutive days of a price increase. So investors and institutions were very sure on changing the pricing of gold and the expectations of interest rate cuts. Do you think that based on that, there is a possibility that the price of gold can continue to increase to that really key psychological level of $4,000, maybe by the end of 2025? Would you say that that is a possibility, or is that too much of a far reach?
If you asked me the same question last week, I would have been a bit really, I mean, I would have been really, really bullish regarding gold's long term outlook.
Hmm.
Now I'm not so sure. It seems, at least from what I see, I mean, in a daily basis or even in a weekly basis, even though, as you said, I mean, we are like for how many days? If we take the latest up leg, we can see
17.
17 days in a row to the upside, really strong, decisive, bullish sessions as well. However, it seems that the momentum is the bullish momentum is fading a bit. I mean, at least from a technical perspective. But it's not only that. I have seen earlier in Bloomberg that gold ETFs holdings also show some signs of overbought conditions. So I'm not quite sure whether there is more of an upside because we're still from fundamental perspective, from a monetary policy perspective, we're still expecting, other than another 50 points rate cut by the end of the year, there is another 100, or I'm not quite sure, for 2026. Not
Yeah,
quite sure how much.
approximately, yes.
So, I mean, considering that the markets are always ahead on themselves, so they will continue to price in these rate cuts. However, it seems that there are some signs of corrections. Might not be really a big correction, but there is the need, or what I see so far today at least, is that there are some signs of correction. So I cannot really be sure, but for the time being, from what we have seen so far this week, I will be really cautious and I will wait for more like confirmation. Because it gives me, the body of the candles, the momentum, the ETFs, as I said, the ETF holdings as well, the gold ETF holdings, the fact that they are already in a bit of a correction mode. It gives me the sense of overbought conditions. So yes, from the one side, from the one hand, there is more to the upside, considering not only the monetary policy, considering tariffs. Still there is a lot of uncertainty and risk around tariffs. So this leads to safe haven demand, as we know. So the fact that inflation is still quite hot keeps the demand for gold. But on the flip side, we might need to see a bit of a correction before another attempt to the upside. So for now, I feel that for the remaining of 2025, we need to see a correction. But I cannot really time when we could see another record high or another sharp move higher. We need to be data dependent, something similar with the Fed.
Do you think
wait
there's
and see, something like that.
Do you think maybe there's a possibility we may see again range-bound trading conditions like we were seeing between May up to August, something similar where investors not necessarily wanted to sell in the long term, but were not ready to continue to buy and keep on pushing higher? Do you think we may see something similar, or do you think it would be a full correction to the previous range?
No, actually, we could see something similar, as you said, with May up to July consolidation. So obviously, we need, to see a bit of a correction on the momentum, slow down. So something like that. Oh no, that's not the why. So something like that, like the at least the MACD, if you're using MACD, if our clients using MACD, to start seeing a slowdown that could support the consolidation. It will be an extra confirmation. It's still early to say to see whether there will be a consolidation or not, but yes, a consolidation, it is possible, especially as long as we don't have a fresh something new that could stretch even more, or it could increase even more, as an aggressive scenario from the Fed. So
what do you think will be key for that to, let's say, change the circumstances? Would you think it's the more on the NFP side and the employment sector, or do you think it would be the main impact would come from the CPI?
It's the CPI. Is the
CPI.
CPI,
Okay.
because for 2 consecutive months, I think it was two. I'm not quite sure whether it was the last 3 consecutive months, but definitely the last two reports from non-farm payrolls, they clearly show a slowdown, especially the last one, which was a massive, massive miss of expectations. Uh, I think because this is what the Fed wanted, right? They, in order to have more room to cut interest rates, they needed the labor market to slow down a bit
Hmm.
though. Okay, not as a their biggest concern right now is the inflation uh, because it seems that the inflation remains stubbornly high at the same time in which we have job markets finally slowing down. So yeah, it's the inflation from now onwards. This is what is driving the Fed to take the next step, to decide what the next step will be.
Hmm.
This is what I believe. What do you think? Is anything else that they it could? I mean, get into the loop of these two uncertain
I
into
think it will
this.
be a mixture of the two. I definitely don't think the Fed, no matter what happens in the employment sector for the rest of the year, if inflation's not going to come down or show signs of coming down, I don't think they will risk a larger cut unless it's something really significant in the employment sector, which would indicate a recession or significant slowdown, which at the moment is not expected. It's in nobody's projection. So at the moment, that is something which is unlikely. We're most likely going to see a similar picture from what we've seen over the past few months, in which case it's a slowdown, but still a resilient employment sector. So it's not necessarily indicating that, okay, yes, it's seen such a significant amount of pressure that actually we're thinking about a recession. We haven't seen that just yet. We're just seeing a slowdown and some weakness in the employment sector, which is still a cause of concern as well. But as long as that continues to be the scenario, and simultaneously inflation remains at an elevated level, but not significantly higher than where it is at the moment, then we're most likely going to continue down the path of what is currently expected, in which cases cautious cuts temporarily. Now, if we're going to see something different, such as inflation rise, then of course that would completely change the scenario. In which case, we'd most likely we'd be looking at a pause for October and then a cut in December, or the opposite, a cut in October with a clear signal at the press conference that we've cut, but due to inflation being elevated, we're not likely to cut at the next meeting or the next two meetings. In
Do you
which
think
case,
that? Sorry. Yes. Continue.
in
Sorry.
which case they're keeping both sides of the party happy. Yes, we've cut to ensure that the employment sector does not keep on weakening, but we're not going to consider further cuts at the next meeting or two in order to keep the pressure on inflation.
Do you think that in the upcoming inflation reading, we're gonna see actually an upside reading? What do you expect basically from inflation this time?
It's difficult to be certain because definitely we would say that tariffs is causing upward pressure on the CPI, that's for sure. At the same time, though, even though we're getting that upward pressure from the CPI, demand has lowered. We can see most likely will continue to decrease steadily due to the weakness in the employment sector. And in addition to that, if we're looking at energy products in the month of August declined. In this month, especially after the Federal Reserve's rate decision, again have declined for three consecutive days. So most likely it can remain at the same level potentially. So not seeing a decrease, but at the
Mhm.
same time not seeing it increase to 3%, 3.2, 3.4, 3.5. Because yes, we've got the upward pressure from the tariffs, which we have already seen impact the market. Yes, not maybe impact it as much as previously thought, but nonetheless impact it. But at the same time, if we look at energy products have slightly declined.
True that.
Lower employment, if that continues, that will also decrease demand as well. So it
We have a
can,
bit of a mix, right?
yes, it can see
Important.
some adjustments on the inflation side, but not something significantly major. Nonetheless, though, even if it remains at the same level, it's at a level the Federal Reserve would not be happy with. So, because of that, they'll be very cautious about being steady on interest rate cuts rather than making big moves, in which case it's unwarranted, it may trigger higher inflation, and they may have to reverse the decision at a later point, which is definitely something they wouldn't want to do,
Mhm.
because that would definitely tarnish Jerome Powell's reputation in the last few months before he leaves the Federal Reserve. What about the stock market, Andrea? Because the stock market actually has gone on to new all-time highs. So even though gold buyers haven't, should we say, jumped on
Yes.
the wagon to take advantage of indications of lower interest rate cuts going forward, but stock buyers actually have.
Uh, you're absolutely right. Let me try and share. No, that's not the case. Sorry, guys. I'm playing a bit around with the screens, trying to find an appropriate layout. Ah,
There we
how that
go.
looks like. Much better, right? So, yeah, stocks. Shall we? Let's see. Have S&P 500 over here. So, as like you said, Michalis, we have seen fresh record highs actually, not only from S&P 500, but it was a really interesting session. It was a bit of a significant day, and a significant week for the stocks as well. Other than Fed impact, we have seen in general the stock market affected by the tech sector once again. So we have seen some new record highs, fresh demand. So there is definitely a lot of support. Let me just get rid of this indicator. Sorry for that. Just to clear a bit. Okay, perfect. So it seems that we have still a lot of momentum on the upside for stocks. But again, it's a combination of factors that support the stocks, and in this case, it's not so much, I think, about the Fed and the monetary policy, but this a lot to do with the tech sector and any development that we see from that perspective. So even though so let me just zoom in just to see also the reaction of the S&P 500 after the press conference. So here we are, supported quite significant, obviously, as we already know, a more of a dovish tone, rate cut decisions, etc., support the corporate world. So that, of course, it was this latest it was mainly from the press conference and Mr. Fed and the Fed and Mr. Powell comments. However, the stock market, as I said, there is a lot of support coming from the tech sector, and this is also something that opens the path further to the upside for the stock markets, for the US indices, and in general, any tech heavy assets, any AI related assets, any tech related assets, and so on and so forth. So after gold, actually, yeah, other than gold, the stocks were the one, the US indices and US stocks are the ones that They were one of the biggest beneficiaries from the Fed meeting this week. And again, even though it looks very similar to gold, I don't know whether you can see this similarity, but we have a long-term bullish outlook seen the second and the third half, the second and third quarter of the year so far. Record highs again and again. I mean, consecutive record highs. But again, I get the sense of an overbought conditions. I don't really see. I don't really see a lot of bullish momentum, even though again and again it posted new record highs. But from a technical perspective, at least, it seems that we have an overbought equity market in general. Overbought, really. I mean, the entire equity market, it looks too expensive. And I'm wondering how long this will continue.
It would also be a very interesting earnings season at the next quarter as well, because if we look at the stock market, which has continuously renewed its high again and again and again, if we look at the past 3 years, earnings has been extremely high. The employment sector has always been extremely strong, even if we go back to COVID-19, where it was the first situation in the past decade where actually there was a real issue in the employment. But at the same time, for the technology market, everything seemed to support it. Everything became online buying, spending more time on the internet, on mobile phones, on computers. So I actually supported the stock market, because even though employment was a big issue, there was so much fiscal expansionary policy that it ensured that demand for products and for the stock market remained high. Now we're in the next quarter, we're actually going to see a quarter for the first time in a long time where there's cracks in the employment sector. So in August, we saw a decline. In September, we saw a decline. In October, we're also going to see a decline as well. For example, for the unemployment rate to rise again, maybe to 4.4, 4.5, then that earnings season will be extremely important, because like Andrea said, it's at a very expensive price. It's an all-time high. And how long can that continue unless it's being supported by the earnings data, the employment sector, or by the monetary policy? So if we're not going to get any support from the employment sector, there's not going to be an adequate and adjustments in interest rates, then if we're not going to get the support from the earnings, quarterly earnings reports, then the question arises of what's going to happen to the S&P 500, the Nasdaq, and the Dow Jones. Of course, there's 3 ifs there: an if for interest rates, an if for the employment sector, and also for the quarterly reports. But it's something, of course, that we have to evaluate and contemplate on.
True that. And other than that, I will add a fourth question mark for this for the stocks near future, let's call it. The fourth question will be whether the markets have already heavily priced in these continued cuts in rates. If they have done it already and we didn't realize that everything has already been priced in, then that means that we will see a correction. So another question will be how heavy, how much the markets have already priced in already the upcoming rate cuts, at least for this year. But on the flip side, usually the fourth quarter, it's a positive quarter for stocks, right? I mean, seasonality perspective, other than earnings seasons, you mentioned earnings season, we have also Black Friday, Halloween. I mean, December is is also a season in which we are seeing um, a lot of boost in the stock market. So yeah, this could lead to sideways movement. I mean, a bit of a more mixed conditions, or have already have everything already been priced in, and we could see corrections from now onwards. I mean, there is more um, to there is more things to keep an eye on, and things that we need clarity as well. So yeah,
For
wonder.
sure, though, while looking at it at the moment, because we cannot tell what's going to happen in the future, but for sure, the trend at the moment is definitely something extremely interesting, and also how the market has reacted, especially in the stock market, uh, after the Federal Reserve's interest rate decision. So, my fellow traders, I mean, we've spoken about quite a lot. We've looked at gold, the stock market. We've confirmed, of course, the Federal Reserve cut interest rates. It was definitely one-sided. We had 11 members vote to cut interest rates. Only one voted not to. Uh, for the forward guidance, like we mentioned, the main possibility, which is currently being advised by economists and analysts, is that we're going to get a 25 basis point cut for October, the same for December. We've seen a lot of volatility and opportunity in the market. Like Andrea said, both potentially in the upside, but also, of course, for the downside as well. Hopefully, you guys found today's podcast educational and informative. Andrea, before we end, would you like to conclude or add something?
Just to keep themselves up to date, try not only to rely on the technicals, and keep news feed next to them, something to keep an eye on the news, because especially this year, it seems that um, you cannot rely on the technicals solely. So you need to keep yourself up to date with everything that's going on from political perspective, geopolitical perspective, central banks, everything. This would be very helpful for them. So stay up to date. This would be my only advice, let's say.
I completely agree. So, guys, let's end today's session. Enjoy the rest of your evening, and we'll see you very soon, either on one of our webinars or on our next podcast. Goodbye.
Thank you. Bye bye.